Adam, would love to start with you. If you could kind of give a little bit more of a definition of what PPLI is, private placement life insurance, and how the product differs from traditional retail life insurance.
So, for nearly 20 years, I've been advising wealthy families how to use specific sections of the tax code to grow their wealth exponentially. You know, Section 72, 101, and 7702 provide unique tax benefits that not enough families use effectively, and that's typically because it hasn't been explained right and it's been sold wrong. See, everybody knows those sections of the code as life insurance, but cash value life insurance has been oversold to a demographic of the population that doesn't need it, and undersold to the demographic that it was really meant for, the affluent. See, everybody likes the tax benefits, you know, the tax deferred growth of cash value, the tax favorable distribution, and even tax free if done right. The ability to switch between underlying investments without recognizing gain, and then ultimately the always income tax free, and if structured properly, the estate tax free death benefit. So what if you could wrap these high growth, inefficient assets inside of an insurance wrapper and get all the same tax benefits that traditional life insurance are afforded? That's private placement life insurance.
Right. Awesome. Then you want to give your spiel. I'll ask you the same question. You can kind of give your definition of it too, and it doesn't have to be like off the book, but I would pose the same question to you. What is private placement life insurance, and how does that differ from typical retail insurance?
You know, it's got a funny name, right? And it's an acronym that comes out as PPLI, stands for Private Placement Life Insurance. And, you know, as Adam said, it's very misunderstood for the most part. Very few people in the country truly understand it. And what you said was very poignant about the section of the tax code that makes it legal hasn't been explored for all of the reasons. I'll go a little further there, because when people ask me, why doesn't everyone know this? And what I say to you is because it's at the crossroads of two different industries that have taken place in the United States. One is the life insurance industry. Life insurance, however far we go back, but let's say in the 50s, was a simple way for people to put money away and get it into sort of a safe account. It was something called whole life insurance. And the whole life insurance was safe, and it was good for families that were interested back then, and people were interested in getting 2 or 3%. The modern stock market, as it grew to the regular people, became more of a thing than I think in the 50s. I'm not sure parents were looking to invest in stocks in the 50s and 60s. So when you're getting 2% returns on your life insurance policy, it seemed like a good deal. Right, because you would get 2%, and people are used to getting that in their savings accounts. Well, as we grew, whole life insurance served that spot. It was a simple concept, and it wasn't highly regulated in terms of who could sell it. It's very easy to sell. Anyone could get their license. In fact, we all started probably with the rate books back then. People would collect door to door for life insurance. So it got a very negative stigma, the word life insurance. And what happened over time is the country grew, and there was this big evolution to the Wall Street type investing, even for the average investor. So like people started getting 401ks, and they started understanding what mutual funds are and what the different investments were. So you had a group of people that were selling basic whole life insurance, which I think is good and has its places, but I don't think it's great. And you have this group of people that were now investment managers, and the two didn't really ever combine. It was this essence that people that were investments were licensed to sell investments, and they wanted to sell stocks, bonds, mutual funds, annuities, all these different things. And then there was life insurance. Steve and I talked about, not that there was a lack of talent in that field, but because very easy barrier of entries, more people went into that probably shouldn't have, so it got a bad name. The investment people wanted to stay in their lane and sell investments. The insurance people wanted to stay in their lane. What happened is, at some point in the mid to late 80s, they decided to turn the two together, almost like chocolate and peanut butter. I just came up with that now, but They said, how can we combine the tax breaks of life insurance that was only affording 2%, 3% return with the oversized returns that we get in the stock market? So companies exist to make a profit, and they started making products that were really good. Probably took 10 or 15 years for it to get in the mainstream of something called variable universal life. That is a great product. It's great, and it's for anyone, right? When I mean anyone, I don't mean any client. I mean, it's not, you don't have to be an accredited investor. You don't have to be a qualified purchaser. You don't have to be worth $5 or $10 million. It's good for pretty much everyone. It's built into it flexibilities that whole life did not have. Lo and behold, supply and demand came for wealthy people to say, we love this idea of having 7702A and life insurance not being taxed on the growth of the money you put in. We like that, but what we don't like is either giving it to one company in their general account of whole life insurance, or we don't like a limit on what we can invest in. We can only invest in public markets, and we don't like a menu of funds. And as any new product that's developing, it gets better iterations, and the costs come down. Once everyone starts selling it, the costs come down. So it used to be a highly cost product, very expensive, and it kept getting better and better because they were doing volume like any other industry. When we got to the world of wealthy people, there's a stat, and I don't know how exact it is, but like 40% of the average, ultra high net worth investor or even high net worth investors tend to be investing more towards alternatives. What are alternatives? It's maybe a little bit long. Alternatives are investments that aren't on public markets. Their short name is called alts. Why would wealthy people invest in alts as opposed to public markets? Well, because what they figured out is with alts, there's not as much regulation. And if you buy Apple and Google, and Steve and I were going to buy Apple and Google, or both buy Apple, we're supposedly trading on the same information. Like the stock market's supposed to be regulated, efficient, no cheating, no insider trading. When you get in the world of privates, which this stands for private placement, the first page, when you get into privates, they're invested in alternatives that are mostly private. What does private mean, private funds? Well, everyone's heard the word hedge funds. Some people haven't. Everyone's heard of private equity. Everyone's heard of private debt, okay? So now the enthusiasm to invest in those things, born a couple of outlets in the United States that will do that. They'll let you choose from not just a prefix menu, they'll let you choose almost anything out there within reason that you can invest and have your cash value in your life insurance. Armed with that, we have developed, because we started, Ron and I, in the high level life insurance, and we evolved to the high level investment situation. And we saw this as the biggest opportunity in the market because it's something that's very, very attractive to high net worth individuals. And why would that be? And I'll let someone else take a second. And I'll ask you, Adam or Steve, why would high-level wealthy people, John, why would they be attracted to something like this?
Yeah, Krosh, can you get into that a little bit more too? Just
Yeah.
from a taxable portfolio perspective, then
Yeah.
using this structure to be able to invest dollars in certain type of assets that go into the
Well,
structure.
a lot of these alternative investments are extremely tax inefficient. There's also there's an illiquidity premium too, and so a lot of times you're not using these dollars for something that you're going to get back right away. Based on that, and based on the tax inefficiency, it's better to own these in vehicles that you don't have K1s or 1099s for, which is exactly what life insurance does. There's no K1s, there's no 1099s.
So it allows you to get and capture the return, the true return that's being done, without having to take greater risk to make up for that loss of tax erosion. See, people, will go for a rate of return, but if they're in an inefficient state, California, Hawaii, New York, New Jersey, those are all 10% plus state income taxes. A 10% state income tax, take New Jersey, on an 8.5% return in a taxable account with a 1.5% management fee, nets you 2.76%. Who would have ever thought that an 8.5% return couldn't keep pace with inflation?
Including the federal tax.
And also to add something which we've talked about is that when you earn, let's say 10, and there's a 2% management fee, 2% management fee is not deductible. So you're paying income tax on the 10, so 10, let's call it 50%, that's 5, minus the 2, you're down to 3.
Yep.
Versus being in private placement where you net 8 and maybe another 1% for all the insurance and everything else, and you're earning 7, that's almost 400 basis points more.
And the beauty of private placement, because we've gone very much in depth, because everybody likes to say life insurance is so expensive, and especially life insurance is so expensive when you get older. Well, we looked at what a low load private placement life insurance contract looks like at a 30-year-old, a 50-year-old, and a 70-year-old, and we took those total loads across for the life of the contract at those 3 ages, and then took those total loads and equated it to if it was a tax. At 30 years old, it's about a 7% tax over the life of the contract versus 43, 50, etc. But at 70, it's only like an 8.5% tax. So the barrier to entry into private placement doesn't drastically change the older you get. Very different than traditional life insurance.
When you say 7 or 8.5%, what are you referring to?
That's if you were to take the loads, the total loads in the contract over the life of the contract, and convert those loads into a tax equivalent.
So it's 7% of the return,
Correct.
they're saying.
Versus
7% of the total return.
correct.
So if you earn 10%, it's like 70
70
basis.
basis points, right. And that's how we say.
versus the income tax, which can be
Right.
50% of the total.
Right.
The big advantage, though, we talked about this with that client, is with the younger person, forgetting that you may have a little bit better net return, is you have many more years of compounding. Because if you buy it as a 70-year-old and you live 15 years, you're not getting the same compounding effect as doing it on a 30-year-old and you have 50 years.
Oh, no doubt. But
Yeah.
the barrier to entry isn't penalizing you for being older.
Right.
Yeah.
Right, and
Let
they're
me-
saying the cost of insurance is older. It's not much.
Right.
And that's how we sort of explain it. And a lot of the funds that John mentioned that are tax inefficient, meaning that if someone gets you a fixed income return that's, the risk of the U.S. bond market, and they get you in public markets, they average the last 20-something years, they average 5%. The ones that we use around that are very similar and actually less in risk, a little bit less, are averaging more like 10% over that time period. So the way I explain it to people is, and I like how you said a tax. So the very simplest way to explain this is that you look at if someone got 10% return and they had it in a regular account at a wirehouse, and it's in fixed income, the broker would get a pat on the back and the average investor would say, hey, you got me 10% last year, you're a great guy, good job, and then he'd get a tax bill that he has to pay about 4%, right, to say whatever. So that equates to 400 basis points versus 100 basis points, but let's use percentages, because a lot of people don't understand basis points. So option 1 is you buy it in your wirehouse account in the same exact investment, the same risk level according to charts as U.S. bonds, and you get 10%. In that account, you're going to have to send 4% of the 10 somewhere, whether it's the state of Connecticut, you miss that high state tax as well, or New York, New Jersey, California. You're going to have to send some to them, but the bulk of it you're going to have to send to the IRS. So if you get 10, you will net 6. And you won't be mad at your broker. You'll still pat him on the back and you'll say, good job, you got me 10% last year. And he's got to pay the 4%. Now, why does he voluntarily pay that? Because he doesn't know any better. He thinks, hey, everyone's got to pay taxes on it. If he does our option and you get a life insurance policy and you put it in the exact same investment, the exact same risk tolerance, and you get 10%, what we figured out mathematically is to have it in insurance, what is the cost of that insurance? And over the life of the contract, it's only 1% of the return. So in scenario 1, without the life insurance, you buy the same exact fund, same exact risk tolerance, you get 10, and you walk away with 6. Under this scenario, you get 10 and you walk away with 9 over the life of 20, 30 years of the contract. That's how small the cost is on life insurance. And 1% is actually very, very high. Most of the time it's only half a point. And what we mistakenly do is what you say, we put our fee in there, but the other person has a fee on their 10% too. So we incorrectly say it's 1%, but that pays the whole system to create this, I hate the word magnificent, but this piece of paper. One more thing, and this is all probably, well, whatever, get cut out of. But the issue is, what I say too, is that if you go in option A and you get your 10%, if you die the next day, and you paid your 4% to the IRS in the state of wherever, so you get 6 and you die, your family doesn't go to the IRS and say, hey, we gave you 4% last year, give us 10, 20, $30 million. IRS is going to say, who the heck are you? Over here, for that 1%, instead of 4, you're getting 10, 20, $30 million to your family. So it has some value.
In life
insurance, right. And I use a little bit of reverse psychology and say, you're not going to die. We know you're not going to die, but if you do, it has some benefit.
You know, I think, Tom, it's amazing, and I say this all the time about private placement. A, it's amazing, it's allowed.
Right.
And B, it's amazing how few people do it based on how good of a product it is. I mean, it really is, and it has to do because it's life insurance. I think if it wasn't, it's not just the life insurance, it's life insurance coupled with the process to get life insurance, having to be underwritten, having to go through medical information. It's like the combination of the term life insurance and the process is basically, you know, if there was a way to have guaranteed issue private placement, where, like, you know, people didn't have to go through it because you're dealing with very wealthy people, and let's say you get enough people and you had like a, you know, like a guaranteed issue, you probably have a lot higher number of people who would do it. Because it is amazing how good of a deal it is, and it's not used by people. And what percentage of people have private placement life insurance?
Very small.
Teeny
But there
little,
is guaranteed issue PPLI on a corporate level.
on a corporate level.
Yeah.
Okay.
But back to the value of the PPLI, what also is amazing about it is that you go and invest in these funds that we heard earlier, the Golubs and the Golden Trees, that are doing 10 and 15% year over year. And let's just say you put, you know, $10 million into your PPLI over time. And, you know, let's just use your money doubles every 10 years. So we're going to do 7.2% to make it not overly aggressive. And you're a 40-year-old person. At 50, your 10 is 20 million. At 60, your 20 is 40 million. At 70, your 40 is 80 million. Now let's just say you die at 70. So you have $70 million of gain built up there. Upon your death, you get 100% step up in basis, and your family gets $80 million, and you didn't pay any tax on that growth.
And with the gift tax exemption that's coming down, you know, sunsetting in 2025, December 31st, 2025, that number of dollars that you're able to shelter for your family is even decreasing even more, from the 24 million range down to, you know, whatever, 14 million range. So again, it's a strategy that we've been utilizing for a lot of our clients that has been super, super effective.
But even with it going down, if you go back to the conversation before about private split dollar, you could do a PPLI with private split dollar and get a lot of that growth out of your estate. But obviously you'll have a note with some interest that's due back to the estate.
Yeah,
So you still have that leverage.
You're arbitraging, and currently, the government sets forth the minimum rate that you can charge before you run into a problem as far as original issue discounts, which means that you have a tax problem. The rate for anything over 9 years, and let's say we're talking about loans for life, and assume that the life expectancy is more than 9 years, the rate is 4.4% in March. Now, you're arbitraging 10% against 4.4%. Now, the other issue you have, let's say that this is in a trust, which now it is in a trust. Well, trusts have rules about them. One of the rules is if you have net income, what's called distributable net income, it either has to be accumulated or it has to be paid out. And regardless, somebody has to pay tax on it. Now, if it's a grantor trust, the grantor has to pay tax on it. If it's a complex trust, the trust has to pay tax on it. And it's in the top tax bracket after $13,000 of income. It's automatically in the top tax bracket. Or if you distribute the money, the people that receive it have to pay tax on it. Plus the fact that if you have a distribution trust, you must distribute that net income. Now, we talked earlier about problems. Maybe a child has a problem with substance abuse. Do you want to distribute to that child for them to go buy alcohol or drugs to feed their habit? Or do you want to cut them off? Well, in a private placement policy, all the income is inside the policy. It doesn't count as distributable net income that goes out. So two things happen. One is that nobody has to pay taxes on it. Two is that you don't have to distribute anything to the beneficiary that has that problem. Three, if you structure the policy properly and pay for it properly, you can take loans against the policy and distribute using those loans, and that is not a taxable distribution. So you're able to distribute tax-free income to your beneficiaries. So that's very, very important. And finally, one of the things that we talked about earlier is if somebody owns stock in their name and it goes up 300% and they die, the basis for the next person is whatever the price was at the time of death. So let's say it was $100, now it's $300. They sell it the next day at $300, they don't pay any taxes because of that step up in basis. In this case, trusts don't have step up in basis. The trust owns it. There's no life involved. So you have no step up in basis. However, life insurance, as we discussed earlier, the death benefit is tax-free. So when somebody gets that money, they got it all tax-free. So what is that? It's the equivalent of a step up in basis. And if you have a long-term trust, dynasty trust, wash, rinse, repeat.
Yeah.
And that's the formula for very wealthy families, and it's repeatable.
Exactly.
And that's something that I think a lot more families are starting to get exposure to. I know the families that we work with, I think it's super important. I know you touch upon it a little bit. You talk about a little bit. Sometimes we talk about the flexibility, right? You want to be able to invest, but you want to still kind of have access to it. Sometimes, people don't want to necessarily tuck that money away or invest that knowing that's just going to the kids. So can you talk about a little bit just in general the flexibility of the cash value inside of those policies, and like you said, how you could loan to the trust? And
It doesn't matter who the owner is. So if the individual owns the policy personally, it's not in a trust, they can take distributions as long as they followed the rules. They can take distributions as loans, income tax free, and as long as they die with the policy still in force, there's no income tax consequence.
Richard, can I ask something there or add something? So obviously, you get the best bang for your buck in the PPLI if you don't start taking loans from it, let it just keep growing, compounding. But going back, Brian, to your question, I'm dad. I do a private split dollar PPLI scenario. I have this loan accruing to me. I mean, theoretically, what could happen, it's not, in my opinion, the most tax efficient way to do it, but the trust could take a loan on the policy, and then the trust could repay dad on the loan that he did for the split dollar to give him cash, and pay down the loan. Again, I don't think that's the most tax efficient way of doing it, but if somebody was concerned that like they've given up access to the money, that's one of the ways they can get the money.
Well, that's one of the beauties of split dollars, because
You
the
didn't make a
person
gift.
that, you didn't make a gift, you made a loan, and a loan can be repaid. So you can get that money back.
What happens, Richard, if somebody did a loan under split dollar, any loan, but let's say under split dollar, at less than the interest rate that the government tells you should do it at, original issue discount, is it taxable income for the difference between the going rate and the rate you paid, or is there more of a tax than that?
There's a complicated formula.
There's a reason I'm asking the question.
There's a complicated formula to figure out original issue discount. But the net result is that it's probably going to be a little more than the difference between the interest rate that you were supposed to charge and the interest rate that you actually
No, because the
charged.
reason I'm saying it in my mind is if I make a loan at 4%, use 4 for simplicity, my estate is growing compounded at 4% on the loan. If I charge 2%, not 4, and even if I had to pay income tax on the 2% of 1%, I'm really only paying 3. It's only costing me 3%, not 4%. So it sounds like the government wouldn't let you do it. It sounds too good to be able to do it.
You also have another problem.
Yeah.
The difference in the interest rates is a taxable gift to the trust.
Okay, so it's a taxable gift to the trust also.
Right.
Okay, got you.
Yeah, because it's a below market rate,
Gotcha.
so it would be treated.
And you're
yeah.
paying, and there's an income tax
Correct.
component to it. Okay, got you.
So it's lucky that it's out there for the few people that understand it, but like you said, it's difficult for people to grasp it because it's not all around. If it was all around every day, like put money in your 401k, what is it? Get your 401k, you go to work. If everyone's that, it's not going to be as good.
There probably is an element of people who don't do it. I think some don't do it because of the whole life insurance piece, and there's probably an element of people who think it sounds too good to be true, and like they're going to be on the front page of the Wall Street Journal if they do it, so they don't want to be part of it.
There are certain rules about it. One, the money that goes into PPLI has to be cash.
Right.
So if a client has assets,
They can't just put the asset in.
they can't put the asset in, and if they have a taxable gain, they're going to have to pay the taxable gain on that asset before they put the money in.
I would bet you that I had this conversation on a young person. Probably, if you did an analysis of somebody paying, because most of the credit stuff doesn't really have capital gains a lot in there.
Right.
But you could probably do an analysis of somebody paying a capital gain and putting the net amount into a PPLI compared to the gross amount outside of the PPLI, and you'd probably show them over the long run they'd have more money in the PPLI because of the extra return they're getting, even paying the capital gain tax.
Well, if they have the money already in a trust and it's being taxed at the highest rate, whether it's an idiot, the grantor pays it or not, the issue is they may not have the cash, but their business stocks in a trust or their other real estate. That money, the offspring of those two things, are now staying in the taxable account. Use the offspring of those money. So the money that's coming off of your business, why keep having it taxable? So have that shoot off into a subset that you have no tax
Well,
on.
you need to have cash flow in those circumstances where you have an asset like a business. You need cash flow in order to be able to do this. And you need substantial cash flow because, what's the minimum? It's $2 million over 5 years. So you need at least $400,000 a year going into this in order to be able to do that. And that's substantial cash flow.
Yeah,
So,
God,
but to that point, and this is personal practice opinion, so, it's not gospel, but, we're very, full disclosure to our clients.
Yeah.
To what Richard just said, if you're not willing to put in an amount of money over a 4 to 5 year period, and you're not willing to let those dollars compound for a minimum of 10 years, if not 15 in the more ideal space, you shouldn't go into any long-term life insurance strategy.
Yep.
Because at that point in time, the costs of the insurance will outweigh the benefits that you get.
Yep.
So this is not put your money in, it compounds 1,000% and you take it out tomorrow. And I try to explain that to people. If they're not willing to let it percolate for 10 to 15 years, they should potentially think about a different transaction.
You have the issue of if you surrender the policy,
Right,
all that income now becomes ordinary income.
right. Which you tell them they never could do. You could shrink the death benefit and do some things like that.
Or you try to do that,
Right.
so that you know that you have a car, so that there's enough that comes out.
Right. But I like to say one last thing. I like to say that you've got to put the money in there for that long, but you can take it out. It's liquid. And here's why I say it, because there's a lot of people said when QOZs came out, Qualified Opportunity Zones, a while ago, it was the greatest thing since sliced bread they put out there, if you had the right opportunity zone. But a lot of the people said to me, I don't want my money to be not liquid for 7 to 10 years. It's just too long for me. So they said no to it. And the idea is this money is liquid. You shouldn't, and you won't get a great return, but it is available.
100%.
Yeah.
But I when explaining, I want to set the right parameters and right understanding so people don't get surprised and angry.
Yeah.
Well, do either of the funds that the IDFs that talked about earlier, do they have specific time periods where you can't take money out?
Yes.
Do
Yes.
they-
Yep.
The
So
average
under-
is about 2 years, maybe 3 years that you can't
Yeah,
touch
yeah.
it, and then some of them have a crawl out. I'm sorry.
Yeah, no, that's just
And
it.
some have redemption schedules that are quarterly. It all
Yeah.
depends on the fund itself. You have to still satisfy.
This is
those.
part of the overarching. This is what we talk about overall planning. Why sometimes people, want the solutions, but it takes time. It takes understanding. It takes working with your team, having those thoughtful intellectual meetings, because there's a lot of complexities to it. But the benefits at the end of the tunnel are very, very important
And
and
you
can be very
have,
valuable.
you have another option. If you put enough money in over time, you can have your own money manager run the money inside the PPLI. And now, or if they're running bonds and other things, you can take the tax inefficient part and put that in the PPLI. And have that same money manager handling the money. So you don't even have to look at the menu of accounts if you're comfortable with that money manager.
Yeah. The managers at IDFs say the ability to not have the trading restrictions on a regular account, like you have to hold in a regular account, not in PPLI for a year. If they had the ability to trade in and out every day, they think it adds 1 to 1.5% to their return, which is the cost of us, right?
Yeah.
So there's lots.
Do they
lots of things.
manage, Tom, do they manage the ID, like does Golub's IDF fund manage differently than Golub's non-IDF fund? Or is it identical?
Well, they're both taxable, right?
No, but I'm saying,
if
do they
you go to a
manage,
stock
but if they
fund-
know the IDF one, there's no tax to the
So-
people, do they manage it differently?
The IDF is not going to be a mirror image of a single fund. Because in an IDF, you have to have proper diversification. So they couldn't just put one fund in there. So typically IDFs are going to be a compilation of a handful of funds that are on Golub's platform or Millennium's or anything else. It's not going to be, if this was, class 1 fund, you're not going to be.
But I
in
get, my
class 1
question
fund.
is, if I'm Golub and I know, like if I'm Golub and I'm managing institutional money, not wealthy people's money, I'm managing a pension fund's money,
Endowment.
I could theoretically manage that money differently than I'm managing Tom Rapp's personal money. Are they managing the IDF funds, do they manage them differently because they could
Yes.
trade more because they don't have to
Especially
worry
the
about
equity
that?
ones. More so the equity.
Right,
either
because
way with debt,
the credit ones, it's ordinary income anyway.
Either way, but
Right.
with the stock ones, they'll sell earlier,
Right.
Yeah.
right? And the same way we have our own SMA, we could trade now, we trade people's stocks inside the Schwab account, and there's no tax friction. So we were just talking to a gentleman today, and
It's like managing it in their pension plan.
yeah,
It's the same as a-
Netflix just went way up, and the video had huge gains in it, and we're like, do you want to peel off now? He's only held them for like 6 months. We would have ordinary income
Right, if it was
tax.
personal,
Now
we'd say, I'm not trading it. He's
we
I don't
get
want to
it.
pay ordinary income tax.
Right.
Now he
I
doesn't
was-
care.
Well,
John,
as a trader at our firm, I log into Schwab and I trade the SMAs for private
PPLI.
placement policies in the same way as a regular account. But those considerations go into it. I can sell out quicker and not worry about cap gains, and it's just you do end up managing it differently. But when you actually are doing the trades, it's the same way. It's the same thing.
Well,
Let me ask you. Sorry to interrupt,
Okay,
Richard.
yeah.
Yeah. Can you let's get a little basic. Let's kind of go back to basic kind of general things on the front end of things. So if someone could just talk a little bit to qualify for private placement life insurance, you have to be an accredited investor and a qualified purchaser. So I don't know.
One or the other.
One
One
or
or
the other,
the
excuse
other.
me. So to qualify for private placement life
trust
insurance.
has to be a qualified purchase.
Yeah. Yep. So to qualify for private placement life insurance, you have to be either a qualified purchaser or an accredited investor.
Right.
So
Accredited investor
Yeah,
is
please.
an income parameter.
Or net
At
worth.
least 200,000 as an individual, 300,000 as a couple, a minimum net worth of $2 million.
Not
Not
including,
counting home.
Personal home.
residence.
Qualified purchaser
Like
is
5
more
million?
of a net worth thing. $5 million minimum as an individual, $10 million together, or the trust has to qualify at least $5 million also.
So what type of client profile are we typically looking for? Obviously, there's some minimums, but what's ideally what we're sort of the sweet spot of who would be a prime candidate for private placement life insurance?
I'm working on a situation right now with an existing client of mine. And he just sold his company. And he's putting the $27 million, the maximum that he can put in, into trusts for his children. And after we had the discussion that we had, and I had that discussion with his attorney, it's all going into private placement life insurance.
As it should.
Yep.
And that's, you know, if somebody's forming a new trust and they're putting dollars in, this is a perfect
Yeah.
way
Yeah.
to handle the money after it's in there.
To answer your question, it dovetails his. Anyone who's rich, right? And what does rich mean, right? You're not going to be talking to someone that's about this product if they're making under $200,000, right? They got to be making a lot or worth a lot. It's just a common sense. Or they usually will pass the tests. If they don't, if they're lower, there's a sister product that's just as good called Variable Universal Life, and that's for people below net worths of $5 million. That's for people with net worths of even 200,000, 500, people making 100,000.
And let's clarify,
And
because I
it's
think
just as good.
And let's clarify, because private placement life insurance PPLI is the acronym that's used. It's really PPVUL, private placement variable universal life, which is the same minus the private placement side is variable universal life as well. So there is similar type product minus the private placement aspect. So
Right.
there's eligibility on different levels depending on
The pricing is different, though. The private placement product is institutionally priced. It's a considerably lower priced product than an off-the-shelf variable life product.
Don't you feel that a client, using like the one that we worked on, that's already investing in private credit, like these things,
Oh, those are the best.
they're much easier ones to get to do it because they're
Yep.
already in those
They
products?
like them anyway.
So that's typically the first one, you know, when to answer Brian's question, who's ideal? Somebody who's already in these high growth inefficient assets and has a
Millennium,
comfort
Gala,
for
Ares, Blackstone.
let Adam talk. Like, try not to because we're going to try to splice up videos to try to not have as much side commentary.
So
one at a time.
people who are already invested in those high growth inefficient assets, the hedge funds, the private credit funds, etc. People who end up with large liquidity events. Dynasty trust planning, where, as we've already said, the top income tax bracket starts at about $14,000 of income, puts you in the top income tax bracket for the trust. And then a lot for pre-immigration planning. So I would say those are pretty much the four ideal candidates for private placement.
And what would you say minimum level, Richard? I think you mentioned earlier. What would you say the minimum funding schedule would be? The minimum funding limits that you would look to place someone inside of this structure?
$400,000 a year for 5 years.
Yeah.
So that's committing. So you would, a person
No.
would,
Right.
we would look to have someone commit $2 million
Yeah.
Yeah.
over the course of 5 years.
It's a $2 million commitment.
Right. But what I was saying, because this topic is about insurance for the super wealthy, ultra high net worth people. There's a sister product that's just as good, and I argue in some cases because the mortality rates because of the competition with VUL are lower because there's only 2 manufacturers, Prudential and Pac Life.
Domestically.
So the loads are different because with the loads you're talking about, the PPLI is called a no-load product because there's no load on it. The other products are loaded, but they have cheaper costs of insurance over time. So if you run an illustration for a 45-year-old, it's going to be cheaper in the product for less because there's no competition. Very interesting.
M can't negotiate the same cost of insurance inside of PPLI?
PPLI doesn't have super preferred.
Okay.
And ultra prefers the other
Right,
companies
that's
do.
right, it's just
and they don't,
preferred
and no
instead.
one's fighting, right? If there were 7 other carriers doing it, someone would come out and say we're the first.
Yeah.
But it doesn't matter. It's a little bit more. So it's good. What you're talking about is good for, I don't say everyone, anyone that's interested in putting money away and paying no tax and put it in investments over time. The sister product called Variable Universal Life is just as good. The absent of being able to invest in alts.
I was going to ask you, so the traditional VUL would not have some of the options that
No
the people-
alts, just good funds. Fidelity, Vanguard,
But
the
all
ones.
registered funds.
Yeah.
Right, but the point is, assuming that that's a segment you want to be in, that's one of the advantages of the PPLI, that you have that opportunity.
Well, our firm has 15 people, and most of them cater in that market. We're at the top of the top here. But there's a lot of people every day selling VUL, which is a great product for young people. In fact, you and all your group are all doing it to get in early on it.
John,
Yeah, I was
can
going to
you-
say,
additional.
yeah, sure. I think if you look at how an endowment or institutional money is managed, there's always a component for alternative investments. That's just how those managers and advisors work with those kinds of clients. And if you're a regular person, you should want to have that same exposure. And the best way to get that inefficient part of that diversified exposure, which is the alternatives, is through private placement life insurance. So you can basically mimic an endowment or a foundation and just put that part of your portfolio in the most tax-efficient way or tax-efficient vehicle.
Adam, let me pose you a question. I'm going to pose you a scenario. We talked about it a little bit earlier, but let me pose you a scenario. Family, north of $500 million. There's patriarch, matriarch, 70 years old and 66 years old, mother, father, 4 children in their 40s. How would you look, what's the best way to sort of, if you're that family, how can you utilize this strategy? Obviously, a lot of it depends on your health and the health ratings and everything, but what would be your sort of waterfall approach to that?
So first off, you have to sit down with the other advisors. You need the trust and estate attorney there, because when you're dealing with wealth at that kind of level, every movement matters. But once you get money out of the estate, no different than you would structure the same waterfall that you would in a dynasty trust with traditional insurance, you can structure it the same way there. If you have no more exemption and you want to move money in, we talked about split dollar earlier, to be able to lend money to the trust to then go into a product like this. So I think we have to remember that private placement life insurance is still life insurance, and it still functions all the same ways as life insurance. You just get to be able to invest in unregistered products inside of this life insurance contract. So you can utilize it in all the same ways as you would for the traditional waterfall effect.
Let's see what else. Anyone else want to go on a? Sorry, I'm burning out a little bit, guys. I'm taking a break.
Take a break.
No. We're rolling here.
What would be good questions? And I wanted to cover it. It's not just for ultra high net
Well,
worth people.
let me. So, I guess, John, I'll pose you this question. A lot of clients that we work with have a taxable portfolio with us, and we've also implemented this private placement life insurance strategy with them. You kind of talked a little bit about the platform and how you're able to trade that, through the platform that we use, and it's pretty much no different than any other. Can you kind of dive a little bit more into that?
Sure.
And how that plays? That's a really good piece to the overall holistic plan.
Sure. Yeah, one of the choices on the menu for private placement life insurance, if we set it up this way, is a fund that we end up managing. And so you have a menu of normal IDFs that you can choose from. And if we set it up in this fashion, we can then have one of those choices be have us manage that for you. And so when we do that, that's where we open up that contract, then has an account at Schwab where we can trade it and manage it in that way. And so it's just one of the options that you have on the menu for private placement.
So that gives our clients an opportunity to, while the menu that's accessible through private placement life insurance is pretty expansive at this point, and there's some really good fund managers like Golub Capital and Golden Tree who joined us earlier. But we've been able to create our own fund to be able to manage it in the way that we sort of see fit. There's obviously some complications with investor control and everything.
Of course.
So there's some different things, but I think that's a nice added piece where we're able to, invest a portion of those dollars that are going into this structure in a way that we sort of see fit as professional managers. We were talking about how when you're hitting certain thresholds, like the dollar amounts, when you're putting in a certain amount, if you're on that lower level, even if we push the envelope and we can get access to more of our fund and kind of have a more personalized investment choice, sometimes it's better to just stay on menu.
So I think the minimum should be more like $5 million versus $2 million. So either $1.25 million over 4 years or $1 million a year over 5 years. Because what percentage of your portfolio are you typically going into alts? It's going to be 10, maybe 20%. Well, if you think about how much you need to have for 10 or 20% to be $5 million, you need a meaningful amount of money. $50, $100 million at that point in time. So I think that, there's, granted that SMA option is great, but I think going into the private placement is ideal for people who want those hedge fund returns and the private credit that are giving you double-digit returns that are typically ordinary income.
And one thing, the biggest question I get too is, we didn't talk anything a lot about 77-208. So people said, like, how much could you put into this? And it got real interesting in 2020 when they raised that limit. I think we all know about. So wealthy people may have been batting their eye at it, like, it's not enough. I could only put $10 million in. The limit just shot up in 2020, almost doubled. So the way I talk about it, people will say to me, and I usually use $1 million for 7 years, and won't get into details of why. It's just to do with MEC testing and actuarial testing to 77-02A. But so the idea is, how much insurance do I have to do? And what I would say is you can put in up to $7 million, right? And you need like $10 million of insurance. Now, the 7 million is really 17, right, million of insurance, because the guy's going to put in 7 plus 10. So it's usually double the amount you could put in as a safe rule of thumb. When they're younger, it's a little bit less. The reason I said it, because people want to know. So they're like, all right, I'm putting 7 million in, and I'm paying the cost of insurance for 10 million. And we say yes, and if you want the insurance, we'll keep it. But if you don't, if you want it for you and your wife, we'll start trimming the death benefit down in year 10 a little bit at a time, which will increase your return. So we can do it's very, very flexible. We talked about it. So someone commits to $1 million a year for 7 years. They say, well, what happens if I do the first 2 years and I don't want to do the third year? Fine, it's going to cost you more for the insurance. But you can actually go back to previous years, so it stacks. So the only thing I'll tell them is on this contract, you can only put $7 million over your entire life, but it could only be $1 million a year. And we won't let you go over it by a penny. And the reason I say that is because then it could become taxable if it MEX. Right, so